Thanks for joining us on the Market Moves interview series. We've been tracking the ETF boom. Huge demand this year, not just in areas like AI, but in natural resources and all the way over to private assets making their way to ETFs. For more context on what's been happening this year, we're joined by Rincon, head of ETF strategy and sales at TD Securities. Great to have you with us.
Thank you for having me.
And a very busy year it has been. In terms of how your job works, tell us a little bit more about what you do.
For sure. So in essence, we were a market maker. So when you go into your machine, let's say you do to a web broker and you want to buy or sell an ETF or a security, those ETFs don't really buy and sell themselves. You need a market maker or somebody else on the other side. So we're there every single day to quote on ETFs all day long. So we're posting a bid and an ask on those ETFs every single day to make sure that there is an orderly market in those ETFs. So we're quoting on thousands of ETFs every single day in the Canadian market and making sure that we're supporting our TD clients, but also everybody else on the street when it comes to ETFs.
Well, and I was mentioning, we've seen such a boom. There's so many options out there, which is keeping you busy every day. But what do you like most about your job?
You know, a couple things. Number one, there's almost one ETF being launched every single day in Canada, and that is fascinating. There's so many different flavors that are coming out in the Canadian market, and it's really keeping us really busy, and I really like to keep busy. That's number one. Number two, I get to talk to all sorts of clients. I get to talk to retail clients, I get to talk to wealth, I get to talk to institutional clients, to ETF issuers. So between those different clientele, it's a wealth of conversations, and I really enjoy that part of my job.
Well, that was one of the reasons we wanted to talk to you, Andres, because you're talking to a lot of people and you know what people are curious about in the ETF world. And I was mentioning natural resources as a subject is getting a lot of attention, but there are these buzzwords, critical minerals, we hear a lot, especially given the geopolitical tensions right now. How has that translated into interest these days in the ETF world?
You mentioned the word buzzwords because that's a big part of the ETF world. Not too long ago, and you'll remember this, the buzzword was rare earths. And everybody wanted to make sure they got into the theme of rare earths. And that was because at the time, the car was being electrified and everybody needed to make sure that everything that went into that car, that Tesla or whatever else, you had all the components, and the supply chain was there for the Teslas and all these companies of this world, for example, right? So anything that was in a battery, anything that was in the electronics of those cars was very important. That conversation has now evolved from just rare earths to real critical minerals. And critical minerals is a word that's used more from a national security point of view. So now obviously the US, the G7, they actually have an alliance. They wanted to make sure that they have the supply and secure the production of critical minerals around the world. Why? Because in a world where we're maybe tending more towards war, we want to make sure that we have, or these countries want to make sure that they have access to these critical minerals and they have access to the supply chain. Now, one of the interesting things is that China and Asia in general are the largest producers of a lot of these critical minerals. So it's not necessarily closer to the G7 per se. So it's really an alliance between all these countries and the world and making sure that they can have access to these critical minerals. So one of the interesting things about ETFs is that when you buy or you want to get exposure to a company that produces these critical minerals, there is a company-specific risk, often, as you know, and then something might happen with the mine or something might happen with their financials. So there's always a lot of risk when it comes to one specific company or one specific commodity. So the benefit really of going towards the ETF is that you get to diversify, really. You get to go into all these different areas in a single go at it, right? So you get exposure to a lot of different companies that have a lot of critical mineral exposure on the production side and or the supply side. So what we see in ETF land is a lot of new ETFs going that way. I'll give you an example. Just in July, we had over $500 million go into critical mineral ETFs alone. That is obviously, there's a lot of interest there, and there's a lot of ETFs that give you exposure to not just critical minerals, but the single minerals too, like uranium, lithium, copper, and other different critical minerals. So, and in Global X actually has a lineup of ETFs that give you exposure to many of these areas. Now, the audience might ask yourself, what is a critical mineral? And to be honest, the definition changes country to country, but the US says it's about 50 different minerals. Canada has a different list. Canada has uranium, the US doesn't. I'm not going to get into the details, but you get it.
But at the end of the day, to your point, thematically, when people are talking about these big trend stories, there's a lot to cover. The ETF avenue is an appealing one, but also it sounds like you're saying the ETF industry is leaning quite aggressively into these themes to offer these products at a reasonable rate.
That's right. There's many ETFs being launched in this space covering single minerals or metals, and also covering all sorts of companies.
So the other interesting thing, especially when there's all these shifting winds of which country is dominant in natural resources or which country is dominant in defense or what have you, the idea of investing in a country story is another big theme for 2025, and one that has been dominant in the ETF landscape as well. What have you been seeing there?
So single country ETFs have been around for many, many years, but since Liberation Day, it's been really the talk of the town, because tariffs, as you know, from many conversations that you have on a daily basis, that's what we hear about every single day. Tariff this, tariff that.
Yeah.
This country is going to be higher or lower. To be honest, I don't know where to go. It changes all the time. I can't keep up with really which country is being tariffed in which way. Now, what we have seen though is a lot of investors use single country ETFs to get exposure to movements in the markets that happen as a result of new tariffs or new deals. So I'll give you an easy example. So after the deal with Vietnam, we saw a lot of movement going into Vietnam-focused ETFs. That market, that equity market in general, is up 16% over last month alone. Similar to when we had an extension in the China deal, that index for a broad China index would be up, let's say, call it 20% over a month, with significant flows over $250 million in some of these ETFs. So we're seeing a lot of interest to go into play these ETFs once a deal gets done or once there's news in these deals. On the other side of that, if there's no deal, we also see a lot of people selling some of these ETFs to get downside exposure to some of these countries. And really, what's really fascinating is that over the last few years, there's been tremendous growth in this lineup. Global X has a lineup in the US of multiple countries, and I can't name them all, but Argentina is one, you have Colombia, you have Vietnam, and a couple other ones. But there's also many other issuers in the US that give you exposure to single country ETFs. So in reality, the investors, when they want to play in the market of, oh, this is what Trump is saying, this is what deal is going to get done, single country ETFs have become a very popular way to get exposure to that.
And this does feel like an evolution from just having exposure to another geography. Do you think even just the acceptance from investors of the concept of single stock ETFs, like even just the understanding of more honed in, focused ETFs, has further opened the door for people to look at these different country opportunities?
And that's a very good point, because people can now be more granular. So before, it was used to be more like you can get exposure to EFI or Europe, and that's very different exposures, different regions. Now with single country ETFs, you're getting exposure to specific countries, Norway, let's say, or many other countries there. So, and what's happening in those countries really diverges versus the performance in other countries. And great case in point is tariffs. Tariffs are per country, not necessarily, well, there's also a Europe deal, but you get the idea, right? Single country ETFs allow you to focus on a specific risk, a specific country, and give you exposures that you want in those countries.
I think that's kind of an opening door for something else that we've been talking about, which is the curiosity around private related assets and the opportunity to invest in those through the public markets and through ETFs. Actually, we did an AMA on the Global X YouTube channel where we got a very specific question about how do I go about investing in private assets through ETFs. Is this an area that's getting more attention right now?
A ton, and it is, in my opinion, the next frontier of growth of products. We're going to see a lot of products there over the next few years. For those of you that are watching, private markets are really what it is it gives you exposure to something that is really illiquid, generally speaking. So a private credit, I'm talking about private equity, I'm talking about real estate. Historically, an ETF really couldn't invest in a building. So you would buy an ETF that buys a REIT, for example, something that's publicly traded, because at the end of the day, the ETF is a liquid wrapper. So if you put something that's illiquid in it, then the question was always like, how do we do this? But now that's actually possible. So now in theory, you can buy an ETF that buys a piece of a building. And that's been a big part of the evolution, and where we're seeing a lot of the conversations. How do you price that ETF? How do you price that asset on a daily basis? How do you trade that asset on a daily basis to sustain creates and redeems and people buying and selling that ETF? That's been a fascinating part of the conversation. And to that point, in the US, one of the issuers in the US launched the first fund with significant exposure to private credit in this example. So this fund specifically in the US can go up to 15% of the portfolio in private credit, but in reality, it can go a little bit higher when it comes to some of what they consider private credit that's a little bit more liquid. So if you look at that portfolio today, it's about 22% of that portfolio is in private credit per se. And these are liquid assets, and they did it in partnership with a private credit manager that can supply them that liquidity. Don't want to necessarily get into the weeds because it can be a little bit complicated, but what it allows is it gives the investor today access to a $30 trillion market. And they did not have access to that before in ETF form, and now they do through these vehicles.
And if people are tracking the markets, they've probably heard references to the return opportunities in private markets.
That's right.
So you think that's the appeal ultimately for people?
So a lot of the enhanced returns that are being talked about in these markets is because of the illiquidity, generally speaking, of these assets, but also the pool of opportunities. There's so many more assets in private world than in public world that you get access to so many different opportunities that you don't necessarily in the public world. So because of that, often you have a diversified or a considerably different set of exposure and risks than you would have in the public world. Number one, and number two, because of the liquidity of those assets, often what we see is the returns are slightly higher than the public market. So people that want slightly higher returns and a slightly diversified exposure or different exposure are the ones that are looking for more exposure in this market.
All right, so we've talked about some of the trends on where capital is flowing. In the ETF world, one of the things that excites a lot of investors is transparency, easy to understand fee structures, and so regulation is something to watch as well. Actually, heading into the new year, something known as CRM III is also worth watching very closely. Can you explain what's happening on the regulatory front?
For sure, and for those of you listening, CRM III is client relationship model, and the third version really being applied in January. And what it will give you, or will force issuers to do, is to provide total cost reporting. And I think I'm very passionate about this. I think this is very, very important. I'm in the ETF business. I'm all about transparency, right? I'm all about liquidity, transparency, and that's what the ETF structure does really, really well. And that's what now regulators are mandating for the entire industry. And I think this is very, very important. So what it will do really is it will give you the fund issuers will be forced to provide more disclosure on all the costs. So what are some of those costs? So generally speaking, when you buy a fund or a seg fund or an ETF, most people just look at the management fee, which is the first thing that pops up in the docs or anywhere. That's just one part of it. That's why you are paying for the manager to manage that fund, right? But then there's many other operating expenses. There's legal, there's marketing, there's taxes. Those are not included in the management fee. Those are part of the MER, or the management expense ratio. So those will now need to be disclosed. And that's important because often they can be substantial. In addition to that, some of the equity funds will also have to showcase their TER, or their trading expense ratio, which tends to be relatively small, but basically anything when a fund trades a lot in and out, there are costs to trading, and those will also put through to the investor through the TER. So they will show the management fee, MER, and the TER, which will ultimately give a good picture of the total cost of owning this fund and managing this fund. So that provides transparency to the end investor as to their total cost of ownership of that fund, and that, I think, is the key part for them to understand as they look to invest long-term in a fund.
And how do you think this will impact the dynamic between, say, ETFs and mutual funds?
That's a great question. Generally speaking, ETFs have done a very good job of externalizing costs. That's why people have gravitated towards the ETF structure. But as you know, there's a lot of money invested in mutual funds today, and this is legacy money. Especially in Canada, if you look at ETF penetration in Canada, it's actually much lower than the U.S. So we are going to see a move more and more towards the ETF structure as you figure out when you're an advisor. Okay, well, you sit down in front of your client, and then you see, okay, well, obviously ETFs are cheaper on a general basis, so perhaps we should move to the ETF structure, right? So that transparency in total cost reporting will likely lead to a move away from mutual funds to ETFs as the end investor starts seeing in their statement, look, why am I paying such and such for a broad market passive index ETF or mutual fund versus what I can pay in an ETF structure that does a very good job of externalizing those costs and it's much cheaper. I think those conversations are really going to be at the forefront of the discussions going forward and going to see a move from mutual fund to ETFs.
All right, so another trend to be watching there. Andres, thanks very much for your time. We really appreciate it.
Thank you.
All right, our thanks to Andres, and thanks for watching. Got an ETF question? Let us know in the comments. And don't forget to subscribe so you don't miss the next video in our Market Moves interview series. See you next time.